Laker Company reported the following January purchases and sales data for its only product. Laker uses a perpetual inventory system. Complete comparative income statements for the month of January for Laker Company for the 4 inventory methods. The comparative income statements begin with sales, minus cost of goods sold, equals gross profit, minus the operating expenses, equals income before tax, from which we'll subtract income tax expense at a rate of 30% to calculate net income. So the sales and the operating expenses will be the same regardless of the inventory costing method chosen. But because cost of goods sold will differ, the remaining amounts will change. The company has 810 units available for sale. Since 440 units have been sold, 370 units are in ending inventory. For the specific identification method, we're told that the 370 units consist of 250 units from the January 30th purchase, 70 from the January 20th purchase, and 50 from beginning inventory. Since we know exactly which units remain in ending inventory, the remaining units must have been sold. 350 units from beginning inventory, 90 units from the January 20th purchase, and none of the units from the January 30th purchase. We multiply the units by the unit cost to calculate total cost of goods sold, $3,430, and ending inventory, $2,390. Since cost of goods sold is $3,430, gross profit using the specific identification method is $4,050. Minus the operating expenses equals income before tax of $2,250. We multiply $2,250 by 30%. Income tax expense is $675. Net income using specific identification is $1,575. Under the weighted average method, cost of goods sold is calculated using an average cost at the time of the sale. We begin with 400 units in inventory at an average cost of $8 per unit. On January 10th, the company sells 300 units. We remove 300 units from the inventory database at the average cost of $8 per unit, removing $2,400 from inventory and recording cost of goods sold. After each transaction, we calculate a subtotal. We have 100 units at a cost of $800 on hand. The average cost remains at $8 per unit. The next transaction is a purchase, adding 160 units at a cost of $7 per unit. $1,120 is added to the inventory database. Again, we calculate a subtotal. 260 units at a total cost of $1,920 is a new average cost of $7.385. The next transaction is a sale of 140 units. We remove 140 units at the most current average cost of $7.385, removing $1,034 from inventory and recording cost of goods sold. 120 units and $886 remain in inventory. The average cost is $7.384. This is a slight change, and it's only due to rounding. The final transaction is a purchase, adding 250 units at a cost of $6 per unit. $1,500 is added to inventory. The month-end total is 370 units at a total cost of $2,386. The month-end average cost is $6.449. Total cost of goods sold is $3,434. Sales minus cost of goods sold equals gross profit, minus operating expenses equals income before tax. $2,246 multiplied by 30% is $674 in tax, resulting in net income of $1,572. Now let's move on to FIFO. Again, we begin with 400 units in inventory at a cost of $8 per unit. The next transaction is a sale. The company sells a total of 300 units. Under FIFO, the first items into the database are the first ones taken out. 300 units from beginning inventory at a cost of $8 per unit, $2,400. The next transaction is a purchase. We had 160 units at a cost of $7 per unit. On January 25th, we have an additional sale. A total of 140 units are sold. The first 100 units presumed to be sold are the remaining 100 units from beginning inventory, at which point the beginning inventory is fully eliminated, and we move to the next most recent purchase, 40 units at $7 per unit. Total cost of goods sold is $1,080. Total cost of goods sold is $3,480. Any units not sold remain in ending inventory. Ending inventory is $2,340. Sales minus cost of goods sold equals gross profit, minus the operating expenses equals income before tax. Minus tax expense equals net income of $1,540. And the final method is perpetual LIFO. Under perpetual LIFO, the last items to come into the database are the first items taken out. The first sale occurs on January 10th. A total of 300 units are sold. The last items to come into the database as of January 10th are the beginning inventory units, 300 units at $8 per unit. The next transaction is a purchase. 160 units at $7 per unit are added to inventory. On January 25th, the company makes an additional sale of 140 units. The last items to come into the database as of January 25th are the 140 units from the January 20th purchase at a cost of $7 per unit. Cost of goods sold is $980. Total cost of goods sold is $3,380. Any units not sold remain in ending inventory. 100 units from beginning inventory, 20 units from the January 20th purchase, and all 250 units from the January 30th purchase. A total of $2,440. Sales minus cost of goods sold equals gross profit, minus operating expenses equals income before tax. We subtract 30% of $2,300, $690, equals net income of $1,610. Which method yields the highest net income? LIFO yields the highest net income, $1,610. In a period of decreasing costs, LIFO will always yield the highest net income. Does net income using weighted average fall between that using FIFO and LIFO? Yes, this will always be true. If costs were rising instead of falling, which method would yield the highest net income? In a period of increasing costs, FIFO will always yield the highest net income,